Imagine waking up to Dogecoin ripping 24% in a single week and then watching it tack on another 11% in 24 hours, price sitting around 0.2 for $7. And feeling that electric mix of exhilaration and wariness every trader knows well. This is the kind of move that attracts headlines, capital, and knee-jerk strategies, but also the kind of move that exposes anyone over-levered or overconfident to swift reversals. The setup we're looking at right now is textbook for a momentum-driven leg higher. On the short-term charts, Doge assembled a classic flag pattern, a sharp vertical run from roughly 20 cents to 24 cents that forms the flagpole, followed by a mild consolidation channel that creates the flag, and then a decisive breakout back above the channel. Traders love flag breakouts because they're continuation patterns with a simple, logical roadmap. Measure the pole, project the target, and manage risk at the lower edge of the flag. In this case, analysts like Trader Tardigrade pegged the immediate, measured move toward about $0.295, citing the flag geometry and nearby fib levels. Ali Martinez highlights a flip from the 0.618 retracement around 23 cents and sees targets clustered between 25 cents and 28 cents, with 27 cents as a key waypoint. That technical coherence is strengthened by the golden cross on the daily chart. The 50-day SMA crossing above the 200-day SMA, which is the kind of medium term, structural signal momentum managers respect because it often correlates with sustained bullish regimes. Together, those price patterns and moving average dynamics give the bulls a clear playbook. If 25 cents is conquered decisively on follow-through volume and price holds above the new breakout zone, momentum players and algorithms will chase higher. Liquidity providers will widen their offers. And the stage is set for a run to the 27 cents $0.295 zone in the coming sessions. Yet the mechanics behind the move go beyond pure chart treating. Derivatives activity has exploded. With futures open interest around $3.5 billion, a reported 8% uptick, and options open interest and volume spiking impressively. Options OI showing a 37% rise to about $3.1 million, and option volume surging 80% to roughly $932 million in a short window. Those numbers are the clearest signal that more sophisticated players, institutional desks, prop shops, and professional speculators are joining the dance. Options volume this high suggests players are buying protection, selling premium, or positioning for asymmetric upside. Futures OI growth implies increased leverage across the ecosystem. Complementing the derivatives picture is on-chain accumulation. Large wallets have reportedly acquired more than 1 billion Doge in recent sessions, roughly $200 million at current prices. And these large holders now control close to half of the circulating supply. That's a striking behavioral shift, where earlier phases of the market saw retail-heavy ownership and sporadic whale whipsaws. The current regime shows coordinated accumulation by deep-pocketed players. When big holders remove supply from exchanges and park it in cold wallets or strategic custody, they shrink the available float and make price moves more sensitive to marginal demand. The same dynamic that causes big percentage moves when demand arrives. Taken together, technical breakout, derivatives-driven momentum, and concentrated on-chain accumulation. The narrative that the Dogecoin run has only just begun gains traction in traders' minds. It explains why so many are now positioning for a continuation rather than a fade, but for every reason to lean bullish. There are equally credible reasons to temper enthusiasm and design a plan that respects fragility. The first and most obvious risk is leverage. $3.5 billion in futures OI is not a trivial number. And as we all know, leverage amplifies both directions. The very mechanics that can accelerate a breakout, forced short coverings, and long levered, momentum can equally turn a modest drawdown into a cascade of stopouts if sentiment shifts. Pair that with spiking options activity. Heavy buying of calls can push dealers into hedging buys that propel price higher, but that hedging can flip rapidly into selling when implied volume collapses, or when realized volume spikes unexpectedly. In short, the derivatives plumbing that fuels rallies also sets the stage for violent whipsaws. Second, concentration brings twin threats, while large holders accumulating is bullish if they're patient. 50% ownership by large wallets also means a coordinated exit or even a few large sell orders can flood an order book that is still relatively thin at higher prices, producing outsized slippage and cascading liquidations for leveraged longs. Third, profit-taking is an ever-present structural force. Dogecoin has the unique cultural momentum of being a meme coin. That attractiveness breeds FOMO, but it also engenders short-term flipping behavior. When a chunk of the market is sitting on swift gains, the temptation to lock profits fuels periodic retracements. Importantly, sentiment indicators in crypto tend to flip fast. The same social media drivers that amplify appreciation amplify fear when narratives sour, and meme coins are frequently the first to price in and then quickly price out social exuberance. There's also the macro and regulatory overlay to factor in. Previously, much of Doge's dormancy was explained by an absence of a clear catalyst such as an ETF approval. Today, the conversation has shifted away from waiting for specific SEC action to watching for technical and on-chain cues. That's a substantive psychological change. When markets pivot from being policy-driven to being data-driven technicals, flows accumulation. It usually implies a shorter-term trading horizon and greater susceptibility to macro shocks. A sudden risk-off move, driven by earnings shocks, macro surprise on rates, or geopolitical flare-ups, can drain liquidity across crypto and turn even structurally positive charts into bear traps. Regulatory news remains a wild card too. While Doge itself isn't at the epicenter of securities debates like some smart contract tokens, regulatory actions affecting exchanges, custody frameworks, or institutional participation can indirectly squeeze meme coins through liquidity channels. Given this cocktail of upside mechanics and clear fragility, what should a disciplined trader or investor actually do? Start by thinking probabilistically and sizing positions for both the upside and the plausible downside. For tactical traders who want to participate in the breakout, use the 23 cents 25 cents area as a structural reference, a clean hold above 25 cents. On higher than average spot volume and sustained decline in exchange balances is the most reliable near-term confirmation that the breakout is real and not merely a short-lived squeeze. Manage risk with defined stops underneath the new support band, for example. Beneath 23 cents or 22 cents as the broader support cushion. And consider scaling entries. Take a small initial position on breakouts and add on confirmations rather than going all in. The presence of a golden cross invites a medium-term allocation thesis. If you're a swing investor, you might hold a core position while trimming at intermediate targets, like 27 cents and $0.295. To realize gains while letting a runner capture further upside, but always keep position size proportional to your risk tolerance. Because volatility can be 30 to 50% intraday in meme coins during these phases, options provide another tool, buying. Limited risk call spreads can allow participation in an upside scenario, while capping downside to the premium and offering leverage with defined risk. Conversely, selling puts can be a way to commit to accumulation at lower prices if you truly believe in a higher long-term target. But selling premium is risky in a market where sudden volatility spikes are common. Beyond individual trade mechanics, watch the key indicators that will tell you whether this rally has legs. Ongoing reductions in exchange Doge balance indicative of retention rather than intraday rotation. Continued accumulation by long-term addresses, not just short-term trading wallets. Stable or rising spot volume that isn't purely derivatives driven, and an options market that reflects constructive skew, i.e., call buying without explosive implied volume expansion. If those things align, the technical targets in the 27 cents, $0.295 band become much more probable. Conversely, red flags include a rapid resurgence of exchange inflows, whale wallets moving to exchange addresses, collapsing spot volume on up, days which suggest low buyer conviction, or derivative structure that flips to extreme leverage on the wrong side, for example. A crowded long book vulnerable to a news shock, We must also navigate narrative risk, Dogecoin's cultural identity. Means the story matters as much as the data. Influencers, celebrity posts, in mainstream media, attention can create the momentum that pushes price higher, but they can also create crowding. Be cautious of strategies that hinge solely on viral narratives without the supporting structure of on-chain accumulation and liquidity depth. Similarly, if you're an allocator thinking beyond the next few sessions, consider the broader thesis. Is DOD's current run part of a durable shift to broader adoption payment rails? Merchant acceptance, integration into platforms, or is it a transient rotation of liquidity, chasing yield from larger altcoin strength? Both possibilities exist. Your sizing and horizon should reflect which you believe is more likely.